The third quarter was a challenging time for investors. Consumer demand was patchy and markets have seen weak demand growth, which has led to calls for further stimulus. With emerging markets seeing little improvement and companies seeing a number of downward forecast adjustments, Mark Burgess is here to talk about the outlook. Hi Mark, thank you for joining us today.
Afternoon, Deborah.
Now, you've just come out of your monthly investment themes meeting. What's been the main topic of discussion?
Well, we've been discussing the state of markets. Clearly, we had a pretty volatile and nervous period over the summer, and the third quarter was a very disappointing time for investors. So markets have recovered their poise somewhat. Both equity markets and credit markets have rallied and have stabilised, and so we've been discussing the background to that and how markets look for the rest of the year and into 2016.
Over the third quarter, it seems that developed world economies have seen a slowdown in growth, and some companies have issued downward forecast adjustments. What does this mean?
I think there were two factors at play, really. So firstly, markets and investors became quite concerned about the slowdown in China.
Yes.
And what we've seen subsequent to that is the aftermath in terms of profit forecasts for companies which have got exposure to China. China is the world's second largest economy. It's very difficult not to have exposure to China. So whether you sell things or make things there, the chances are you're making less profit than you were. And we've seen a number of companies announce that. And then secondly, we've obviously seen a very sharp fall in commodity prices, and that has ramifications for companies involved in that sector of the market.
Mark, you've touched on the subject of oil and mining. Capital expenditure has been cut back, and there has been talk of a potential industrial recession in the US next year. What's your take on this?
I think the prospects for an industrial recession have been overstated, although certainly companies exposed to oil and mining and energy more broadly are doing quite badly at the moment. There are a number of industries that are doing very well. The airline industry, for example, and air travel is benefiting from the fall in oil prices. But if you're exposed to energy in any way, shape or form, then there is certainly a reduction in capital expenditure and it's being played through. And if you look at the shape of the US economy, capital expenditure for shale oil production, for example, was about a third of total US capex last year. So although it's not a particularly large industry on its own right, in terms of its marginal impact on capital expenditure more broadly, it's quite a big feature.
So we've talked about volatility over the recent months. Is it still a major issue?
Absolutely, and if anything, it's increased. I think we've seen stock-specific risk go up as companies, whether they're exposed to China, whether they're exposed to the commodity price, whether they're involved in that food chain somewhere, have warned on profit forecasts. I think volatility has increased, and I think it's incumbent on active managers to be absolutely on top of the stock-specific risks they have in their portfolios and really understand the drivers to the business models of the companies that they own.
So what issues are affecting commodity markets right now, and how does China fit into this?
Well, commodity prices have fallen very sharply, and China is pretty critical to this. As we've discussed, China is slowing down as they switch from an investment-led model to a consumption-led model. And part of the impact that has is that they are consuming less commodities. They have been the marginal consumer of many commodities to quite a large degree. They've been half the steel market, for example. So that has been very, very impactful, and that has led to a sharp fall in prices that the market has to readjust to. And we're seeing companies cut back in terms of their exploration and production, and they're cutting back in terms of their supply. But all of that has to work through the system, and we're not yet through that.
So Mark, this is a rather cautious outlook that you're giving us at the moment. Where would you say we could find opportunities, though?
Yes, I guess I probably do sound more cautious than I have done for a while, and I think it's a function of slowing GDP growth globally, driven by China, and also the deflationary impact of the fall in commodity prices. I think the value that we find, however, is that we're still overweight equities. We still think there are prospects for growth in corporate profits, but as importantly, because of the deflationary forces and because of the slowdown in GDP growth, the likely rise in interest rates, I think, is deferred. The ECB last week has recommitted to the quantitative easing program. The Bank of Japan is still supplying liquidity to its market in a large fashion. And we think the outlook for US rate rises is very modest. So the interest rate environment will be supportive, I think, of equity markets and risk assets more broadly.
Well, thank you very much for your time, Mark, and thank you for watching. We'll be back again next month.